have been lied to about your credit score. For years, the financial industry has kept the actual mechanics of the credit system behind a veil of confusion, hoping you would believe that building wealth is slow, complicated, and entirely out of your hands. But here is the truth. Your credit score is not a reflection of your moral character or your intelligence. It is a mathematical algorithm. It is a game of data points. And once you understand the rules of the game, you can stop playing for survival and start playing to win. If your score is stuck in the high 600s or the low 700s, you are leaving thousands of dollars on the table in interest payments alone. You are paying a convenience tax on every car loan, every mortgage, and every apartment lease you sign, simply because you do not know how the system reports your behavior. We are going to strip away the myths today. We are going to look at the cold, hard numbers that determine your financial mobility in the United States, and I am going to show you exactly how to manipulate your profile to get the highest possible score in the shortest amount of time. Let us start with the biggest lie in the industry, the idea that you need to carry a balance on your credit cards to build credit. If you take away nothing else from this conversation, hear this clearly. You never, ever need to pay a single cent in interest to have a perfect credit score. Carrying a balance does not help you. It does not prove anything to the lenders. It only costs you money. The credit bureaus do not care if you pay interest. They care about two things: capacity and reliability. When you carry a balance, you are actually sabotaging your score because you are increasing your credit utilization ratio. This is the single most powerful lever you have. Think of your credit limit as a bucket. If that bucket is full, you are seen as desperate. If that bucket is nearly empty, you are seen as wealthy and responsible. You want to keep your utilization under 30%, but if you want the highest possible score, you need to treat 10% as your ceiling. If you have a $5,000 limit, your statement should never show a balance higher than $500. It is that simple, and it is that mechanical. But how do you handle your spending if you want to keep that utilization low? This is where the timing trick comes in. Most people wait for their statement to arrive in the mail or their email, see the balance, and then pay it. That is the wrong way to do it. Your credit card issuer reports your balance to the bureaus on your statement closing date, not your payment due date. If you spend $3,000 on a $5,000 limit and your statement closes on the 15th, the bureaus report that you are at 60% utilization. They report that you are a high-risk borrower. To fix this, you must pay your balance down to a low nominal amount before that statement closing date. Log into your account on the 10th or the 12th. Clear the majority of the debt before the bank even has a chance to tell the credit bureaus what you owe. You keep the utilization record artificially low, and your score rises automatically. Now, let us talk about the foundation of your report, your payment history. This is 35% of your FICO score. It is the bedrock. A single late payment can wipe out months, sometimes years of hard work in 30 days. This is why you must automate the minimum payment on every single account you own. Do not trust yourself to remember dates. Do not trust the mail system. Set it up so that the bank automatically pulls the minimum due, regardless of your income or your cash flow that month. This is your insurance policy. If you have a missed payment on your record from a year or two ago, you are not out of luck. You can utilize a goodwill letter campaign. Most people do not know that you can contact the lender's executive office directly to request a one-time adjustment. You are not asking for a favor. You are presenting yourself as a loyal customer who made a clerical error and is asking for a correction. It works more often than the banks will admit.
While you are fixing the past, you must look at the present structure of your credit file. If you are just starting out, or if you have hit a plateau, you need to leverage the history of others. This is the authorized user strategy, and it is entirely legal. If you have a family member with a long, pristine credit history and high limits, ask them to add you as an authorized user on their oldest credit card. You do not need the physical card. You do not need their PIN. By being added to that account, their decades of on-time payments and low utilization suddenly become part of your file. Your average age of accounts increases instantly, and your total available credit jumps. This is the fastest way to artificially inflate your score, especially if you are younger or have a thin file. It's the credit equivalent of getting a head start in a race. Next, you need to look at your credit mix. The bureaus want to see that you can handle different types of debt. A credit score that relies solely on credit cards is considered less reliable than one that shows a balance of revolving credit and installment loans. But do not go out and take a loan just to improve your score. That is a trap. Instead, look at the accounts you already have. Are you managing them with long-term intent? The age of your credit accounts matters. This is why you should never close your oldest credit cards, even if you don't use them anymore. Every time you close a card, you reduce your total available credit, and you eventually shorten your average age of accounts. Keep those old accounts open. Buy a cup of coffee on them once every 6 months to keep the issuer from closing them due to inactivity. Treat your credit history like a vintage wine cellar. The longer those accounts have been open, the more valuable they are to your score. We have to address the hard inquiries. Every time you apply for a new loan or a new card, you trigger a hard inquiry. This is a signal to lenders that you are looking for more debt. If you're shopping for a mortgage or an auto loan, you have a window of time where multiple inquiries for the same type of loan are treated as one. Do not apply for a credit card, then a car loan, then a personal loan in a short span. You are flooding your report with red flags. Be intentional. If you need a credit limit increase, call the issuer and ask specifically if they can perform the increase with a soft inquiry. Many banks will do this if you are a customer in good standing. A soft inquiry does not touch your score. It gives you more breathing room and lowers your utilization without the temporary penalty of a hard check. This brings us to the biggest challenge: consistency. The reason most people fail is not that they don't know these strategies, it's that they don't apply them every single month. Your credit score is a living, breathing document. It is updated every time your bank sends data to the bureaus. You should be auditing your report at least twice a year. Use the official channels to get your free disclosures. If you see an address that isn't yours, a name that is misspelled, or an account that you did not open, you must dispute it immediately. The bureaus have 30 days to verify the information. If they cannot prove that the debt is yours, they are legally required to remove it. Do not be lazy about this. There are millions of errors on credit reports across this country, and most of them are negative. You are effectively paying a penalty for a clerical error that is not your fault. Look at your life as an investor looks at a portfolio. Your credit score is your access to leverage. When you have an 800 score, the banks are calling you. They are offering you lower rates. They are offering you rewards that actually put money back in your pocket. When you have a poor score, you are the one chasing the banks, and they are charging you for the privilege of borrowing your own money in the future. It's a cycle that keeps the middle class in a permanent state of repayment. You break that cycle by treating your credit report as a business asset. You stop thinking about how much you can spend and start thinking about how your spending affects your reporting. The strategy is clear. Automate your payments so you never miss a deadline. Pay your balances before the statement date to keep your utilization suppressed. Become an authorized user to borrow the credibility of someone with a longer history. Keep your old accounts open to anchor your profile. And finally, be aggressive about disputing any error that appears on your file. If you do these 5 things, you will move the needle faster than 99% of the population. There is no secret sauce. There is no mysterious entity in a dark room deciding your fate. It is math. It is data. And the moment you decide to take control of that data, you are no longer a consumer in the system. You are a player in the market. Every decision you make regarding your credit cards, your loans, and your payments is a move on the board. Make your next move count. Build your score not because you want to take on more debt,